Good morning, everyone. I got this comment on my Nick Cage Saving for Retirement video. I talked about saving money for a down payment on an investment property, and he said, where might we store that money until we find that property to invest in? Savings, Roth IRA, bonds, Robinhood? And this is a really good question because for our first property, we just let the money stack up in our savings account. There's no risk, but there's no reward either. So this comment got me thinking, is there a better way to invest that money while you're saving it? Could you get to your savings goal faster if you put your money somewhere else? Maybe. If I did do that though, I would want to test it against 4 factors: return, risk, liquidity, and fees. Return would be how much I'm going to make off of moving my money somewhere else. Risk would be how likely I am to lose money on that investment. Liquidity is how accessible my money is. So if I'm planning to save for 2 years, but the perfect property comes up in 18 months, can I still access my money? And fees are pretty self-explanatory. Am I putting this into an account where I'm going to be charged for holding my money there or charged commissions if I'm doing any type of trading? Okay, so with those things in mind, I did some research and made this chart. So across the top, we have 4 short-term savings options. And down the side, we have our 4 tests. So if we look at that first row, the annual return on a $15,000 balance, I looked up the rate of return on our savings account, and it's 0.01%. So over a year, that would net us $15. Score. If we were to put that money into a high yield savings account, which typically can yield around 3% on average, we'd be looking at $450. If we put it into bonds or CDs, we could expect around 4%, which would be $600 for the year. And then if we put it into a self-managed brokerage account like Webull, Robinhood, Fidelity, basically putting it in the stock market, if we saw a 6% return, that would be $900. If we saw a 10% return, that would be $1,500. But this is the first option in which we could lose money. And if we lost 5% of our portfolio, that would be a negative $750. So then if we look at the other 3 tests, risk, liquidity, and fees, the savings account and the high yield savings account are identical. There's no risk. It's fully liquid. You could just write a check straight out of that account typically. And usually there's no fees. Bonds and CDs, there's very low risk. There's probably not any fees, but your liquidity is affected. Typically, you can't access the money from your bonds and CDs until a maturity date. If you do pull money out before then, you could incur fees, or at the very least, you're not going to get the full return that you expected to get. So this goes back to that 2-year example. If I get a 2-year bond, but the perfect property comes up in 18 months, then it's going to be a little bit more difficult to access that money. And then the self-managed brokerage account, it's important that it's self-managed, because if you get a managed brokerage account, then you will have fees and commissions most likely associated with it. So with this one, your risk goes up. You're looking at a medium to high risk. The stock market is pretty volatile, so your balance will most likely change day to day. Some days it'll be up, some days it'll be down. As far as liquidity, it is pretty liquid. You just have to sell the positions that you have. So that could take some extra time, or you could end up selling at less than what you thought you would. But unlike bonds and CDs, you can pretty much access that money whenever you want. And then lastly, there should be no fees associated with a self-managed account. So again, we have just been saving our properties in our savings account, making that measly 0.01%. And after looking at this chart, I don't know if I'm convinced enough to change that. My goal with that savings account is that once I have saved up the down payment and identified the property that I want to purchase, that account will probably be drained and I will start the process all over. Would I love to have an extra $1,500 to kickstart the next property? Totally. Is that extra $1,500 worth my sanity and peace of mind throughout the year as the stock market does this? Probably not at this point. I want to know with 100% certainty that when I am ready to write that check for that property, that the funds are available. I might consider a high yield savings account, make that extra $400 a year. But to be honest, there's also a convenience factor. I'd have to have my savings at a different bank. And I like having everything under one roof. Seems silly, but that's just me. I want to know what you guys do when you're saving for an investment property, or if you've heard any advice from somewhere else that you'd be curious to try out. Thanks for watching. Hope you guys have a great rest of your day, and I will see you next time.